Welcome back to the Deep Dive. Big one today.
Oh, yeah.
Canadian tax updates for 2025.
A lot to unpack.
We've been digging deep into some sources, government websites, of course.
Always a good place to start.
But also some expert analysis.
Love that.
For real estate tax tips on YouTube.
Oh, yeah.
They're always on top of things.
Super informative.
Even caught a video from BNN Bloomberg.
Nice.
So we're ready to break down all the need-to-know info.
Let's do it.
Especially what it means for you.
Your wallet gonna feel some changes.
Buckle up.
Because we're covering everything.
From tax bracket tweaks.
Those are always interesting.
To those CPP contributions.
They keep going up.
And hold on.
What's that?
Brand new first home savings account.
Ooh, I like the sound of that.
Even a GS there all in it.
Everyone loves a tax break.
And
but there's more.
For our real estate investors out there, we're diving into changes to short-term rental deduction.
Big implications there.
And those new trust reporting requirements.
They can be tricky.
You ready to get started?
Absolutely. Let's dive in.
Okay, let's start with the news everyone cares about.
Hit me with it.
Tax bracket adjustments.
Everyone wants to know about those.
They happen every year.
That's right.
But what's the real impact for us in 2025?
So basically, think of it this way.
Okay.
The government is trying to adjust the tax brackets to keep pace with inflation.
Right.
So you're not unfairly penalized as prices go up.
Makes sense.
Essentially.
Yeah.
A larger portion of your income will be taxed at a lower rate.
So that's got to be good news for our take-home pay, right?
Absolutely.
Give me the numbers.
Let's say you're earning $100,000.
Okay.
In 2024, you would have paid about $21,000 in taxes.
Oof.
But with the 2025 adjustments, you're looking at about $20,646. That's an extra $354 back in your pocket.
Okay, I like the sound of that.
Right.
But now let's talk about those CPP contributions.
Uh-oh.
They're going up again, right?
Unfortunately, yes.
I know it's for our future benefit.
It is.
But it still stings a little bit in the present.
True, but these Canada Pension Plan enhancements mean higher contributions in 2025.
Okay.
But it's all about building a stronger foundation for your retirement.
Got it.
So here's how it works.
Lay it on me.
Let's say you earned $50,000 in 2025.
Okay.
You subtract the basic exemption of $3,500.
All right.
Leaving $46,500 of pensionable income.
Gotcha.
Then you multiply that by the contribution rate,
which is
5.95%, giving you a CPP contribution of $2,763.
Now, self-employed folks need to pay extra attention here, right?
Oh, definitely.
Because they're wearing two hats.
Exactly.
Employee and employer.
That's right. If you're self-employed, you're responsible for both halves of the contribution.
Oh, boy.
You're essentially doubling that amount.
Oof. Definitely something to keep in mind.
For sure.
Now, there's also something about a two-tier CPP structure.
Oh, yes.
What's that all about?
So that's a newer aspect of the CPP system.
Okay.
There's a maximum amount of earnings that are subject to the standard contribution rate.
I see.
In 2025, it's set at $71,300.
Right.
Any income you make above that, up to $81,300,
got it,
is subject to an additional 4% contribution.
So if you're a higher earner,
you're
contributing even more to CPP.
Precisely. Let's say someone makes $100,000.
Okay.
They'll contribute based on the first $71,300.
Right.
And then an extra 4% on the earnings between $71,300 and $81,300.
Gotcha.
That works out to about $293 more compared to 2024.
Wow.
Or double that for those who are self-employed.
That adds up.
It does.
It's clear that understanding how the CPP system works, especially with these added layers,
definitely
is crucial for both employees and the self-employed.
Couldn't agree more.
What's next? Let's move on to something a little more cheerful.
Oh, good.
The RRSP contribution limit is going up.
Love that.
More room to save for retirement is always good news.
You got it for 2025. The RRSP contribution limit is bumped up to $31,560.
Wow.
Giving you even more opportunity to shelter income from taxes.
Right.
And grow your retirement savings.
Now, how is that limit actually calculated?
Good question.
It's not just a random number, right?
It's tied to your earned income from the previous year.
Okay.
You can contribute up to 18% of your earned income.
Got it.
But it can't exceed that maximum limit.
So, for example, if you made $80,000 in 2024, your RSP contribution room would be $14,400.
That's right. But don't forget
what?
To factor in any pension adjustments.
Right.
If your employer contributes to a pension plan, that affects how much you can contribute to your RSP.
So those pension adjustments are essentially deducted from your contribution room.
That's exactly right.
And always remember,
important tip,
to double check your notice of assessment from the CRA.
Always a good idea.
For the most accurate information about your specific contribution room.
Can't stress that enough.
Excellent point. It's always best to go straight to the source for that kind of detail. Speaking of saving for the future, what about the TFSA limit?
Any good news there?
You bet the annual contribution limit for your TFSA is going up to $7,000 in 2025.
Wow.
if you've never contributed before,
Yeah.
you'd have a total cumulative contribution room of $102,000.
That's amazing.
That's a lot of space to grow your money tax-free.
It is, but
Well,
it's crucial not to overcontribute.
What happens if you go over that limit?
You'll face a penalty of 1% per month on the excess amount.
Ouch.
And this is a critical point for anyone who's not a resident of Canada.
Oh, right.
You cannot contribute to a TFSA if you're not living here.
Absolutely. In fact, Real Estate Tax Tips had a real-life example
Oh, no.
of someone getting hit with a double whammy.
Whites.
Penalties for over-contributing and for contributing as a non-resident.
Look good.
Definitely not a situation you want to find yourself in.
Exactly. Those penalties can add up quickly.
Yeah.
It's essential to be clear about your residency status.
Right.
And if you're unsure, it's always best to consult with a professional.
Sound advice. Okay, we've covered RSPs and TFSAs.
2 great tools.
Which are both fantastic tools for building long-term wealth.
Love them.
But speaking of saving for the future,
What else is there?
there's a new program that's creating quite a buzz.
Oh, tell me more.
The First Home Savings Account, or FHSA.
That sounds interesting.
It's kind of a hybrid of an RSP and a TFSA, right?
That's a great way to put it. The FHSA blends the tax-deductible contributions of an RSP
Okay.
with the tax-free withdrawals of a TFSA,
Wow.
all with the goal of helping you buy your first home.
Okay, that sounds pretty awesome.
It is.
But what exactly qualifies as a first home?
Good question.
Are we talking strict definitions here?
The rules are a bit more flexible than you might think.
Okay.
Essentially, neither you, your spouse, or your common law partner can have owned or lived in a property in the past 4 calendar years.
Oh, interesting.
And you can only use the FHSA once in your lifetime.
So let's say you owned a condo 5 years ago, but have been renting ever since.
Right.
Would you still be eligible for the FHSA?
You absolutely would.
That's great. So how about contribution limits?
All right.
What are we looking at?
You can contribute up to $8,000 annually.
Okay.
With a lifetime limit of $40,000.
And can you carry forward any unused contribution room?
Like with the RSP?
Yeah.
Absolutely any unused contribution room can be carried forward to the following year.
Okay, cool.
Which means you could potentially contribute up to $16,000 in a single year.
Wow. That's a lot of flexibility.
It is.
Now, this next update is something we can all get excited about.
Oh, I love excitement.
The G-Stest holiday is back.
Everyone loves a tax break.
A little break from those taxes is always welcome.
It's true. From December 14th, 2024 to February 15, 2025.
Nice.
A select group of goods and services will be exempt from the GST-10.
We're talking things like
Let's see.
children's clothing, diapers, car seats, books.
Yep.
Even some food and beverages.
Sounds good.
Perfect timing for those holiday shopping sprees.
It's important to remember, though,
What's that?
that the exemption only applies if the items are both purchased and used during that holiday period.
So plan your shopping strategically to maximize those savings.
Exactly.
All right, we've covered a lot of ground here.
Ooh.
Tax packets, CPP contributions, RSPs,
Yep.
TFSAs, the new FHSA,
We've covered it all.
and even a GSSD holiday.
Nice work.
But now let's turn our attention to some updates that are specifically relevant to real estate investors.
Oh, this is my
You
jam.
ready to dive into that well?
Absolutely. Let's get into it. So we're going to unpack some key changes affecting short-term rentals.
Okay, for those of you running Airbnbs or similar ventures,
Exactly.
listen closely.
Big shift happens starting January 1st, 2024.
Oh,
You can no longer deduct expenses for your short-term rental
really?
if it doesn't comply with local regulations.
So if you're not licensed
Right.
or playing by the rules set by your city or town,
Exactly.
you're going to see a much bigger tax bill.
It's a significant financial hit. Real Estate Tax Tips on YouTube illustrated this perfectly.
Oh, yeah.
Let's say you're running an Airbnb
Okay.
and haven't registered with your municipality,
Oh,
even though it's required.
right.
You have $6,000 in expenses for the year.
Like cleaning fees,
Yeah.
utilities, maybe even mortgage interest.
Exactly.
But because you didn't register,
Right.
none of that is deductible.
No.
If your tax rate is 50%,
Yeah.
that's an extra $3,000 in taxes.
Ouch.
That's a hefty price to pay.
It is.
This really drives home the point that complying with regulations isn't just about following the law.
No.
It's about protecting your bottom line.
Absolutely. Get those licenses in order and keep meticulous records.
Yeah.
It could save you thousands.
Solid advice. Now, let's shift gears to another update.
Okay.
That might be on the radar for real estate investors.
Right.
Trust reporting requirements.
This one can get a bit complex.
I bet.
But the gist is that the CRA has introduced enhanced reporting requirements
Okay.
for most
Report.
trusts, effective January 1st, 2025,
All right.
with the first filing deadline in March 2026.
So who exactly needs to pay close attention to this?
It's broader than you might initially think.
Oh,
Let's say you're the legal owner of a property,
okay.
but your parents provided the down payment,
Right.
and are the ones living there.
Gotcha.
Even though their names aren't on the title,
Yeah.
you would still have filing obligations.
Wow, so even if it's a family arrangement,
Yeah.
it still needs to be reported.
That's correct. Other scenarios that trigger filing include holding property for corporations
Right.
or having joint venture partners.
I see.
Essentially, if there's a mismatch between who legally owns the property
Right.
and who benefits from it,
Gotcha.
we'll likely need to file.
This definitely sounds like a situation
It is.
where getting professional advice is essential.
Absolutely.
A tax expert can help you determine if these rules apply to your specific circumstances.
I couldn't agree more.
Right.
It's always better to err on the side of caution.
Definitely.
With these complex reporting requirements now.
Okay.
Let's tackle a change that's been a hot topic.
Ooh.
How capital gains are taxed.
Ah, yes.
The capital gains inclusion rate.
There was a lot of talk last year about increasing it.
That's right. The proposal was to bump it from 50% to 66.67%.
Wow.
Meaning instead of only half of your capital gains being taxed,
Yeah.
2/3 would be...
But it got postponed, right?
It did until at least January 1st, 2026.
Okay.
But there was some confusion about how this postponement would affect the 2024 tax year.
Really?
The CRA initially kept 2 reporting periods on the capital gains tax form. One for gains before June 25th, 2024.
All right.
And one for gains after.
Okay.
Which caused some head scratching.
It definitely seemed overly complicated.
It was, but the good news...
What's that?
...is that it doesn't affect how much tax you owe for 2024.
Oh, good.
You still add all your capital gains together.
Okay.
And apply the 50% inclusion rate.
So, even though the form might look a little different,
right,
the bottom line is the same.
That's right. The BNN Bloomberg video did a great job explaining this.
Oh, yeah.
The CRA has confirmed the 50% inclusion rate applies to all capital gains realized in 2024.
Gotcha. However,
yes,
there is an important exemption to note.
Oh, tell me more.
If you own assets personally, there's a $250,000 exemption threshold.
Okay.
So for the first $250,000 of capital gains,
right,
you can still apply the 50% inclusion rate.
I see.
But any gains above that amount
would
be subject to the 2/3 inclusion rate if and when it comes into effect.
Exactly.
So there's an incentive to hold on to assets personally.
At least for the time being.
It seems that way. It's definitely something to consider.
It is.
When planning your investment strategy.
This whole saga underscores how important timing is when selling assets.
If you have some control over when you realize those capital gains,
precisely,
aiming to stay below that $250,000 threshold could be a wise move.
It could be.
And don't forget, you can also offset capital gains.
Oh, yeah.
With any capital losses you might have incurred.
Absolutely, if you've got some investments that haven't performed well.
Right.
And use those losses to reduce your tax liability.
On your gains.
Exactly.
Strategic planning is key.
For sure.
Making the most of the tax rules can make a big difference.
Now, while all of these tax updates are important, there's one more that's particularly relevant given the rise of the gig economy and online platforms.
Ooh, this sounds like it could apply to a lot of our listeners.
It could.
Let's dive into that. So we're talking about new reporting requirements.
Exactly.
For anyone earning income through digital platforms.
Think Etsy,
Uber,
Airbnb.
The whole gig economy shebang.
It's all about making sure everyone is paying their fair share of taxes on this type of income.
Right. It's become pretty common these days.
It has the government wants to level the playing field.
So they're requiring these platforms to collect and report information about their seller.
To the CRA.
Exactly.
If you're selling goods or services online, get ready for some new paperwork.
Oh, boy.
Your platform will be sending you an annual summary of your earns and other relevant info by January 31st each year.
So think of it as a handy little helper.
Yeah.
Come tax time.
Exactly. This information will make it easier for you to accurately report your income on your tax return.
Keep in mind, these reporting requirements apply to the 2024 calendar year.
Yes, so you'll be receiving your first summary in early 2025.
It's a significant change.
It is.
But it ultimately promotes fairness and transparency in the tax system.
Couldn't agree more.
All right, we've covered a ton of ground today.
We have.
From tax bracket adjustments and CPP contributions.
Those are important.
To the ins and outs of RSPs, TFSAs. And even the brand new FHSA.
Don't forget that one.
Plus, we unpack those key changes for a real estate investor.
Big one.
Like short-term rental deductions. And trust reporting requirements.
Those are important to understand.
And, of course, we couldn't forget about the capital gains inclusion rate saga.
What a ride.
It's been a whirlwind tour of the 2025 tax landscape.
It has, but hopefully you're feeling more informed and equipped to navigate these changes.
Remember, strategic financial planning is essential.
Absolutely.
And if any of this feels overwhelming, or you're unsure how it applies to your specific situation,
it can be confusing.
Don't hesitate to reach out to a qualified tax professional.
They can help.
They can provide personalized advice.
For sure.
Help you maximize deductions and credits.
Definitely.
And ensure you're meeting all your filing obligations.
That's key.
So as we wrap up this deep dive into Canadian tax updates for 2025.
Great episode.
Let's leave you with a final thought to ponder.
All right, I'm ready.
With all these changes in motion.
Yeah.
How do you plan to adapt your financial strategies and maximize your financial well-being in the coming years?
That's the question everyone should be asking.
It's a question worth reflecting on.
It is.
Understanding the tax rules is one thing.
Right.
But using that knowledge to make informed decisions that align with your financial goals.
Yes.
That's what truly matters.
Couldn't agree more.
So take some time to digest everything we've discussed today.
Lots to think about.
And see how you can apply these insights to your own financial journey.
Your future self will thank you.
Thanks for joining us on the Deep Dive.
It's been a pleasure.
We're glad you could come along for the ride.
Until next time.
Happy investing, everyone.